You ever do that thing where you're feeling responsible, like genuinely proud of yourself, and then somehow it still backfires? Like maybe you finally decide to apply for a new credit card, or you walk into a dealership just to see what your options are, or you click that innocent little button that says, check if you pre-qualify, and then, a few days later, your credit score drops. Not by a lot, maybe 5 points, maybe 12, but it drops. And suddenly you're staring at your credit app like, wait, what did I do wrong? Because nobody tells you this stuff in plain English. They just throw around phrases like hard inquiry and credit impact and expect you to nod politely while quietly panicking inside. I'm Nick, and honestly, I spend way too much time thinking about money, credit psychology, and the weird little rules hiding behind our financial system, the ones that quietly affect people who are actually trying to do the right thing. And here's the thing most people don't fully understand. Hard inquiries don't just nudge your score for a few weeks. They can sit there, quietly, for up to 2 years. Yeah, 2 years. But the real story, it's more nuanced than the internet usually makes it sound. And once you understand what's actually happening behind the scenes, you stop fearing hard inquiries and start using them strategically. So let's talk about it. What a hard inquiry actually is and why it exists. Okay, first, quick reality check. A hard inquiry isn't punishment. I know it feels like punishment. It feels like you asked for credit and the system said, cool, here's a tiny slap. But that's not really what's happening. A hard inquiry is basically a lender saying, hey, we need to look closely at this person's credit because they're actively asking for new debt. That's it. When you apply for a credit card, auto loan, mortgage, or sometimes even certain apartments, the lender pulls your full credit report. That full pull, that's the hard inquiry. Now, why does it affect your score at all? Because from a risk perspective, and this part is important, people who suddenly apply for a lot of new credit tend to be statistically riskier. Not always, obviously, but on average, yes. Think about it like this. If your calm, responsible friend suddenly starts opening 5 credit cards in 1 month, you'd probably raise an eyebrow, right? The scoring models are doing the exact same thing. Why this matters to you? Understanding this removes the emotional sting. The system isn't judging your character, it's just reacting to risk patterns. Actionable takeaway. Before applying for anything, ask yourself, do I actually need this credit right now? Because timing matters more than most people realize. Why the impact lasts up to 2 years. Now, here's the part that freaks people out. You'll often hear credit inquiries stay on your credit report for 24 months. And technically, yes, but also, and this is where nuance lives, the impact doesn't usually last the full 2 years. Let me explain. There are 2 different timelines happening at the same time. The inquiry remains visible on your report for 24 months. The most of the scoring impact fades after about 6 to 12 months. This is one of those things the internet rarely explains clearly, and it causes a lot of unnecessary stress. Picture it like footprints in wet sand. At first, they're deep and obvious. Over time, the tide comes in, smooths things out, and eventually they're barely noticeable, even though technically they're still there. That's basically what happens with hard inquiries. Why it matters? If you're panicking about a hard inquiry from last year, honestly, it's probably doing very little to your score now. Actionable takeaway. Don't obsess over old inquiries. Focus on your recent credit behavior. That's what lenders care about most. The real reason multiple inquiries hurt more. Now, this is where people accidentally shoot themselves in the foot. 1 hard inquiry? Usually minor. 5 hard inquiries in 2 months? Now the system starts getting nervous. Because remember, the scoring models are pattern detectors. They're not just looking at what you did, they're looking at how often you did it and how quickly. Let me give you a real-world style example. Imagine 2 people. Person A applies for 1 credit card this year. Person B applies for 4 credit cards, a personal loan, and an auto loan in 6 weeks. Who looks riskier? Even if person B is completely responsible, the pattern itself raises red flags. And honestly, I've seen this happen so many times. People don't even realize they're stacking inquiries. They're just checking store financing, shopping for cards, looking at auto loan rates, clicking pre-approval buttons, and suddenly, boom, inquiry pile. Why this matters? Clusters of inquiries signal potential financial stress to lenders. Actionable takeaway? Space out credit applications whenever possible. Slow and intentional beats fast and reactive. The mortgage and auto loan exception most people miss. Okay, deep breath, because this part is actually good news. Not all hard inquiries are treated equally. When you're rate shopping for a mortgage, auto loan, or sometimes student loan, credit scoring models usually group multiple inquiries into one, as long as they happen within a specific window. This is called deduplication, though nobody outside the credit industry uses that word in normal conversation. Here's how it works in plain English. If you apply with multiple auto lenders within roughly 14 to 45 days, depending on the scoring model, the system assumes you're shopping for one loan, not opening 5 separate debts. So it counts them as one inquiry event for scoring purposes, which honestly makes sense when you think about it, because responsible borrowers should shop around. Small personal aside, this is one of those rare moments where the credit system actually feels reasonable. Why it matters? You can shop rates for major loans without destroying your score if you do it within the window. Actionable takeaway? When rate shopping, do it within a tight time frame. Avoid stretching applications over months. Be intentional about the shopping window. Timing here is everything. How much a hard inquiry actually drops your score? Now, the million-dollar question: how many points will I lose? And I know this is frustrating, but the honest answer is, it depends. Yeah, I know, not satisfying. Stay with me. For most people with solid credit, a single hard inquiry usually costs somewhere between 3 to 10 points. That's it. Not 50, not 100, not financial doom. But, and this is the important but, the impact is bigger if your credit history is short, your file is thin, you already have multiple recent inquiries, your overall profile is borderline. Think of your credit score like a shock absorber. A thick, well-established credit file absorbs inquiries easily. A thin file? Every bump feels bigger. Why it matters? Context determines impact. The same inquiry affects different people differently. Actionable takeaway? If your credit file is young or thin, be extra selective about new applications. The psychological trap nobody talks about. Okay, can we talk about something slightly uncomfortable for a second? Because this part is less about math and more about human behavior. A lot of people don't get hurt by one hard inquiry, they get hurt by the reaction to the first inquiry. Here's what I mean. Someone applies for a card, score drops a few points. They panic. They start Googling. They apply for another card to improve utilization. They check store financing. They chase pre-approvals. And suddenly, the real damage begins. It's not the first inquiry, it's the spiral. Honestly, I've watched people accidentally create 6 inquiries in a month just from anxiety-driven decisions. And the system, cold, statistical, emotionless, just sees rising risk. Why it matters? Emotional reactions to credit changes often cause more damage than the original event. Actionable takeaway? When your score dips slightly, pause, breathe, wait 30 days before making new credit moves. Most of the time, patience beats action. When hard inquiries actually matter most? Here's the quiet truth. Hard inquiries matter most when you're about to apply for a big thing, like a mortgage, an auto loan, premium credit cards, or certain rental approvals. In everyday life, though, they're usually background noise. But in the 3 to 6 months before a major loan, suddenly they matter a lot more, because lenders start looking at your recent activity very closely. It's kind of like showing up to a job interview after frantically applying to 12 other companies that morning. It doesn't automatically disqualify you, but it raises questions. Why it matters? Timing your credit behavior before major applications can save you thousands in interest. Actionable takeaway?
If you plan to apply for a mortgage or auto loan soon, avoid new credit applications for 3 to 6 months beforehand. Keep utilization low and let your profile look calm and boring. Boring credit profiles get the best rates. Conclusion. So, when you step back and really look at the whole picture, hard inquiries aren't the villain they're often made out to be. They're not credit score death sentences, they're not permanent damage, and honestly, for most people with healthy credit habits, a single inquiry is barely more than a small ripple in a very large pond. What actually matters, the thing that quietly separates people who struggle with credit from people who master it, is awareness. It's understanding the timing, the patterns, the psychology behind your own decisions. Because once you realize that inquiries fade, that clusters matter more than single events, that rate shopping has built-in protection, something shifts. You stop moving reactively. You stop panicking over every 7-point drop like it's a financial emergency, and you start playing the long game, the calm game, the intentional game. Honestly, and